In this session, we're going to use a panel data set of bank financial statements to create a function that will calculate the value of deposit insurance for any bank that we specify. And we're going to calculate the deposit insurance using an approach that was in a paper by Merton in 1977. This is a real options approach to deposit insurance valuation. A link to the paper is here. If you're familiar with put options, this is a brief reminder of what a put option is. So the idea of a put option is if you own the put option, you have the right to put the asset, the stock, if you will, if it's put option on stock, to the seller of the put option for price K. So if the stock is worth less than K, then you'll put it to them to the option seller, the put option seller, and receive K for the stock value. So you'll receive K minus S sub T. And if the price of the stock is above the strike price, the price at which you can put it, then you won't exercise it. So the payoff on a put option here is the maximum of 0 or the strike K minus the stock price at expiration of the option. So we can value deposit insurance using this approach. The idea here is if you're a bank and you have deposit insurance, that means that you can put, if your assets, the assets are going to be S, right? If your assets are less than your deposits, you can put the deposits to the federal government, right? So the federal government will cover, if your assets are less than deposit, it'll cover the deposits minus the assets. Of course, if your assets are greater than greater than the value of your deposits, then the insurance is not needed and the payoff would be 0. So just like we can value put options via this methodology, right? We can also value deposit insurance. There's a little bit of background about deposit insurance here. What we're going to do is, we'll talk a little bit about this, but deposit insurance from the FDIC only covers $250,000. We're not going to take that into account. So we're going to give a sort of a rough estimate of what the value of the deposit insurance is. So what we're going to do here is we're going to import our libraries, pandas, numpy, and we're going to use scipy stats. So we need the cumulative normal density function. So we need norm from the scipy stats module. Now the data here, I'm going to go ahead and read this data in while I talk. This is a panel data set. So what this means is we have observations on all FDIC insured banks over time. So for each bank, we have a time series, right? So that's where we have a panel. So our data set is both cross-sectional, meaning we have financial statements for a given bank at a given time across its financial statements, deposits, assets, so forth. But we also have, so it's cross-sectional, but we also have a time series component, meaning we have these observations over time. Like previously, this data set had to be compressed, so it should be a CSV file hosted in a compressed format on GitHub. So let me see. And so Pandas is going to nicely uncompress it and read in the data set. So we should have it here now. So what we can see here is this is going to be this is the unique identifier of the bank, and this is the time series, right? So so here's the quarter, right? So this is just the unique ID and the time in one. And then when we scroll right, we have assets, and we have lagged versions of those assets. We have a lot of different, most of which we won't need. We have, these are small business loans and so forth. Whether the bank is a de novo, whether it's during the financial crisis, all we're going to need here for our purposes is deposits and assets. So this gives a little bit of a description of the data. So first thing we can do is go ahead and pull only what we want, right? And then rename the columns to make life a little bit easier. So now if we take a look at, let's go ahead and take a look at what we have. So we have a panel with easy to refer to columns. Now what we want to do is, again, we're just cleaning the data. Like we looked at last session, we want to get rid of anything with NAs. Right, so if we don't have particular data on it, then we can't do the calculation, right? So we'll go ahead and drop the NAs, So we're keeping only complete cases here, rows with entries for every column. Now, we looked at this a little bit before. If we want to subset a panel, we can subset a panel by this creates that Boolean. This says create a Boolean that shows either true or false, whether the IDR SSD is equal to 37. And then here that selects all those rows where the Boolean is true. So we're going to use this in our function. We can subset the data, the panel, very easily using this. Now, one thing we haven't seen before, but if we look, what if we wanted to get a list of all the IDR SSDs, all the banks, right? These are the unique identifiers for the banks. We can't just pull, if we just pull panel and IDR SSD, we're going to get a lot of them are going to repeat. So we can call this set function, and that will give us a unique. So if we actually want to get a list of all the banks, for example, if we wanted to calculate deposit insurance for every bank, right? Then we could use this right here. Good. So now let's create a function. And why are we creating a function here? Well, this will allow us to have user input whatever bank they would like to see, and then get the deposit insurance valuation out, right? So this would be, it could be incorporated nicely into sort of a web app where the user has maybe a drop-down box where they can choose the bank that will map to the IDR SSD, and then for that bank it'll call this function and then output the results. So we're gonna create this deposit insurance value function, and as arguments, it's going to require that you put the IDR SSD, so no default value. It's going to provide default values for the risk-free rate and time. So the risk-free rate of 1%, time of 1. This is 1% per period, time of 1 period. Normally people are going to use years, but strictly speaking, it's period and period. And then the panel where if they want to provide a particular data set. However, if it has a default for panel, if that's loaded into the global namespace. So walking through the function here, we've seen this is just going to create a temp data frame, which subsets the panel for only that, returns only the panel for that particular IDR SSD, for that particular bank. And then we're going to calculate the standard deviation of the log change in assets. So unpacking this a little bit, what we have is, let's remember, evaluation is going to be from inner to outer. So we can go in here, and what this does is this just pulls the assets, right, from the data frame, and this calculates the log. So this log is going to act on each entry, right? So we have we're just pulling the assets column, and then we're calculating the log, right? And then we're calculating the difference, right? So this is going to be log changes. So remember, we and if I didn't mention it, the Merton 1977 model. This is a Black-Scholes world. So to calculate changes, we don't use percent change. We use log changes, right? So you might see this as log of the new value divided by the old value, right? So log of new assets divided by old assets, which is the same as log new assets minus log old assets, right? So all we're doing here is calculating log changes and then calculating the standard deviation. And we're actually annualizing it, multiplying it by 4. So I should say this is strictly annual. So multiplying it by the square root of 4 to get an annual value. These lines here simply get the last deposit and the last assets. So this, in the option pricing model, this is going to be equivalent to our strike price and our stock value if this was a typical put option. The tail just gets the last value. is the calculation of D sub 1 and D sub 2 in the Black-Scholes model. This is where, so we're using NumPy power function, not necessary to use that, but convenient, and NumPy square root function. And then in the calculation of the actual value, that's where we need the SciPy stats norm cumulative density function. So right here, this is a calculation of the Black-Scholes value of a put option. I won't go through that here. There's plenty online. Maybe I'll put a link to it online here, but that's just an implementation of the Black-Scholes value of a put option, right? And then what we do is we calculate the deposit insurance value as a percent of, or percent of latest deposits. So we return a value per deposits, right? So how much is it per dollar of deposit? So if we can read this in, we should be able to go ahead and, so this is Granville Bank, and go ahead and calculate deposit insurance value, and we get about 1 cent per dollar deposits, which is actually quite high. We can go ahead and calculate this for a different bank, and this is substantially lower. I think I have a link to it here. These are the actual rates from the FDIC, and these are in basis points. So we're looking here, it's based on the Camel's rating of anywhere from 1.5 to 30 basis points, so like 0.3%. So the highest here really is 0.4%, 40 basis points. Basis point being 1/100th of a percent. So we can go here and take a look, and if we would like, we can calculate it for a single bank, but we can also, and it's also convenient to calculate it for a set of banks. So what I've done here is let's create a set of banks. So this is the unique list of IDR SSDs, and we're going to pull the first 100. So we can do that. Now, if we wanted to apply this function to a set, we can use a list comprehension, which we've introduced earlier. So this is going to calculate the deposit insurance value of X for X in the set of banks. So it's, again, a much more convenient way of writing a for loop, in essence. And then this gives us resulting values. We can, actually, this is just going to recalculate it and store it. And we can calculate the average, and we're getting 87 basis points. So our value here is about twice as high as what we're seeing here. So it's a little high. Of course, the idea here is, one, we're calculating it on total deposits, and actually there's substantially less deposits than that insured, because deposits are only insured to 250,000. So that would lower it if we fix that. We're also using, these are financial statements. So these are sort of book values where market values might be a little different, and we should be using market values. However, I mean, we're pretty close in the ballpark here. Like I say, we're a little high, but I think a lot of that can be explained by the fact that we're looking at all deposits, not just whereas the FDIC is looking at only a subset of that deposit, and so it's safer. Good. So that's a way we can implement deposit insurance. It shows how we can do slightly more complex calculations, option valuation in Python as well. As an exercise, one thing that we could say here is, well, maybe we only want to value the option when we have a year of data, at least a year of data. So what you can do is, in this function, first check that there's a year of data before calculating the deposit insurance value. And if there's not a year, return a message saying not enough data, right? Or not a sufficient amount of data. And what you could do is right here, it would be fairly simple to check the shape of this temp. So you can check the shape of that. If it doesn't have sufficient data, go ahead and have it return something and stop the remainder of the calculations. Otherwise, continue on. Excellent. Have a great day.